Every country on Earth is in debt. The United States, Europe, Japan, China, even oil-rich nations. But if everyone owes money, who exactly is owed? This episode traces the hidden history of sovereign debt, from the birth of government bonds in 17th century England to the modern global system where promises trade hands faster than nations can repay them. Debt is not a failure of the system. It is the system. Through historical case studies, England, France, the United States, Japan, Greece, Argentina, Sri Lanka, we expose how debt became the architecture of power, how credit disciplines governments, and why modern economies are designed to refinance forever rather than repay. This is not conspiracy, it is structure. Welcome to the Shadow Economist, where money, power, and history collide, and nothing is ever as simple as it looks. Credit is not money, it is permission, and permission, once granted, can always be revoked. Most people believe governments rule nations. They vote, legislate, declare wars, raise flags. But beneath that visible theater runs a quieter hierarchy, one that does not campaign, does not give speeches, and does not answer to crowds. It speaks in numbers, not laws. Ratings, not rights. Yield curves, not constitutions. This is the layer where real obedience begins. History shows this pattern clearly, but only if you look past the surface. When empires fell in the past, it was often blamed on decadence, corruption, or invasion. But long before armies marched, credit tightened. Long before flags fell, confidence evaporated. Spain learned this in the 16th century. Flush with silver from the Americas, it appeared unstoppable. But its wars were financed not by treasure alone, but by loans from Genoese bankers. When Spain defaulted, not once, but multiple times, the empire didn't collapse immediately. It weakened. It lost flexibility. Decisions became reactive. By the time decline was visible, control had already shifted from kings to creditors. The same lesson repeated in France before the Revolution. The monarchy wasn't overthrown because it lacked land or armies. It collapsed because it could no longer borrow. When lenders refused to extend credit without reforms, sovereignty cracked. The Estates General were convened, not the Estates General, but insolvency. Politics followed credit, not the other way around. This pattern never disappeared. It simply became more sophisticated. In the modern world, power does not announce itself through conquest. It arrives through assessment, through risk models, through ratings. A country today does not fall because it runs out of soldiers. It falls because it runs out of trust. Credit rating agencies sit at the center of this invisible empire. Moody's, Standard & Poor's, Fitch. Private institutions, born in the early 20th century, tasked initially with evaluating railroad bonds in the United States. Their roles seem technical, even boring. Measure risk, inform investors. But over time, these assessments became destiny. When S&P downgraded US debt in 2011, markets shook, not because America was suddenly poorer, but because the illusion of unquestioned credibility cracked. When Greece was downgraded to junk status in 2010, its fate was sealed before austerity was ever voted on. Interest rates exploded, refinancing became impossible. Democracy was cornered by arithmetic. What followed in Greece was not policy failure. It was credit enforcement. Pensions were cut, wages slashed, assets privatized. Entire industries sold under pressure. Not because voters demanded it, but because creditors did. The European Central Bank, the IMF, and the European Commission, the so-called Troika, dictated terms. Elections changed faces. The program remained. This is what credit control looks like in practice. Argentina knows this cycle intimately. Since the 1980s, it has defaulted repeatedly. Each time, the narrative is moralized. Irresponsibility, populism, mismanagement. But beneath the rhetoric lies a simpler truth. Argentina borrows in currencies he does not control. It is structurally dependent. Every recovery is provisional. Every crisis resets the hierarchy. Japan, by contrast, carries debt exceeding 250% of its GDP, far higher than Argentina ever did. Yet markets remain calm. Yields stay low. Why? Because Japan borrows in its own currency. Because its institutions are trusted. Because its debt is owned internally. Same numbers, different power. This is the core misunderstanding most people carry. Debt levels do not determine obedience. Credit structure does. Italy and Germany share a currency, but Germany borrows cheaply, while Italy pays a premium. Not because Italy works less, but because markets believe Germany will always be protected. Credit is not neutral. It is political, but without politics. Even the United States, seemingly untouchable, operates within this framework. Its privilege is not infinite, it is conditional. The dollar's reserve status, US Treasury bonds as global collateral, the Federal Reserve's credibility, these are not laws of nature. They are maintained perceptions, and perceptions must be managed. This is why central banks speak in careful language. A single sentence from the Federal Reserve chair can move trillions. Not because of action, but expectation. Credit reacts to tone before it reacts to policy. When Paul Volcker raised rates in the early 1980s, he crushed inflation, and entire developing economies along with it. Latin America entered a lost decade. Debt denominated in dollars became unbearable. Mexico defaulted. Brazil staggered. The IMF stepped in, not as a rescuer, but as a gatekeeper. Structural adjustment followed. Privatization, liberalization, cuts. The same pattern repeated globally. This was not cruelty, it was enforcement. Credit does not care about intention. It responds to risk alignment. And this is the most uncomfortable truth. Markets do not hate instability. They price it. A country that obeys will be refinanced. A country that resists will be punished. This is why sovereign power today ends at the bond market. Governments can promise anything, but if borrowing costs spike, those promises evaporate. Budgets are not expressions of will. They are negotiations with lenders. Even war obeys this logic. The United States could fight prolonged conflicts in Iraq and Afghanistan, not because they were cheap, but because it could borrow endlessly at low rates. When borrowing becomes expensive, foreign policy shrinks. Credit is strategy by other means. This is why the post-Stoic strategist studies finance, not politics. Politics explains rhetoric. Credit explains outcomes. And this brings us to the deeper layer, the one rarely discussed. Behind ratings, behind central banks, behind governments themselves, sits the institutional ecosystem that actually allocates belief. Pension funds managing retirement savings, insurance companies pricing longevity, sovereign wealth funds recycling trade surpluses, hedge funds arbitraging spreads. All of them demand one thing above all else: stability. Not justice, not growth, predictability. They don't care who governs, only whether the rules remain legible. This is why revolutions scare markets more than dictatorships. Not because they are immoral, but because they are unpredictable. Credit does not oppose power, it disciplines it. And once you see this, the illusion dissolves. Governments do not borrow because they choose to. They borrow because the system requires circulation. Markets do not lend because they are benevolent. They lend because interest is the rent paid for continuity, and obedience is not enforced with tanks, it is enforced with spreads. The real hierarchy of the modern world is not rich versus poor, or left versus right. It is credible versus expendable. Those who understand this do not protest the system. They position within it. Because in a world where credit decides survival, the ultimate freedom is not independence. It is credibility. And credibility is earned not through morality, but through alignment with the architecture of power. The rest is noise. Once you understand that credit is obedience encoded in mathematics, the modern world rearranges itself in your mind. You stop asking why governments behave against the wishes of their citizens. You stop asking why austerity always arrives after elections. You stop asking why crises are always unexpected, yet always resolved in favor of the same institutions. Because the decision is rarely political. It is financial. Consider the Eurozone. Greece, Italy, Spain, Portugal, all sovereign nations, all democratic, all bound by a shared currency they do not control. When trouble comes, they cannot print. They cannot devalue independently. They must negotiate. Germany, by contrast, benefits from the euro without surrendering credibility. Its borrowing costs fall when others rise. Capital flees SAF and flows north. The system rewards discipline, not because it is moral, but because it is predictable. This is not a conspiracy. It is geometry, and geometry does not argue. The same structure applies globally. Developing nations borrow in dollars because global trade demands it. When the Federal Reserve raises rates, capital flows back to the United States. Currencies weaken elsewhere. Debt becomes heavier overnight. Nothing local changed, only the center moved. This is why Sri Lanka collapsed in 2022. Tourism revenue dried up. Foreign reserves vanished. Dollar-denominated debt became impossible to service. Fuel ran out. Food shortages followed. Protest erupted. Government fell, not because of ideology, because of liquidity. Lebanon followed a similar path. A banking system built on confidence collapsed when dollars disappeared. Savings were frozen. The currency imploded. Middle-class wealth evaporated without a single law being passed. Credit is faster than legislation. Markets move before parliaments can speak. And yet, after every collapse, the same language returns. Reform, restructuring, confidence-building measures, new bonds, new terms, new obligations. All the machine does not end. It resets rift. This is why debt forgiveness is rare and conditional. When it happens, as in post-World War II Germany, it is strategic. The London Debt Agreement of 1953 erased much of Germany's burden, not out of mercy, but necessity. Europe needed stability. Growth required a solvent anchor. Creditors sacrificed short-term repayment for long-term order. Debt relief is not moral, it is tactical. And that is the rule across history. Rome debased its currency to fund expansion. Venice perfected public debt to finance trade. Britain industrialized through bonds. America rose through deficits. China expanded through state-directed credit. No empire avoided debt. Those that collapsed mismanaged belief. Because debt itself is not fatal. Loss of confidence is. This is the distinction most people never learn. They fear numbers without understanding relationships. They hear trillions and imagine collapse without realizing that scale is relative to trust. Japan proves this. The United States proves this. Even Italy proves this, surviving not because its finances are pristine, but because the European Central Bank stands behind it. The moment that backstop is questioned, spreads widen, markets test resolve. Credit is always testing. It probes weakness, like water finding cracks. And this brings us to the most important realization of all. At the top of this system, there is no master controller, no single villain, no hidden council directing outcomes. There is only alignment. Institutions respond to incentives. Capital responds to safety. Power responds to continuity. The system does not care who you are. It cares whether you fit. This is why individuals feel trapped. They are told to think morally in a system that rewards structurally. Work harder, be responsible, save, obey. With the real rewards flow to those who understand positioning, not participation. The same applies to nations. Countries that resist the logic of credit are isolated. Sanctions are simply the formal version of this process, a denial of access to settlement, financing, and trust. Iran, Russia, Venezuela, different ideologies, same outcome. Isolation is not exile, it is illiquidity, and illiquidity is suffocation. So when you hear leaders speak about sovereignty, independence, or freedom from debt, listen carefully. The world they operate in does not reward purity. It rewards integration on acceptable terms. The post-Stoic strategist does not rage against this reality. He studies it. He understands that debt is not a moral failing, but a lever. That credit is not slavery, but structure. That obedience is not submission, but calibration. He asks different questions. Not, how do we eliminate debt? But who holds it? Not, how much do we owe? But in what currency? Not, is this fair? But is this sustainable? Because sustainability is power's favorite word. And sustainability does not mean balance. It means continuation. The final illusion is this, that debt must one day be repaid. For governments, that day is always deferred. The real obligation is not repayment, but servicing belief. As long as interest is paid and narratives remain intact, the system endures. That is why inflation is tolerated. That is why currencies erode slowly. That is why savers lose quietly. Debt shifts the burden through time. Inflation shifts it through classes. And silence ensures it continues. Because the most obedient populations are not the most oppressed. They are the most distracted. Entertained, polarized, consuming noise while structure operates untouched. History shows us this clearly, not once, but repeatedly. When belief collapses suddenly, revolutions happen. When belief erodes gradually, systems persist. That is why the modern world prefers managed decline over rupture, gradual adjustment over reckoning, rolling crises over final ones. Debt allows time to be stretched. Time allows power to adapt. And this is the final truth. The world does not owe money to anyone in particular. It owes continuity to the system that makes money possible. You are both debtor and creditor, taxpayer and beneficiary, worker and collateral. There is no outside position, only awareness. And awareness is the only leverage left to individuals in a world governed by credit. When you see debt clearly, it loses its mystique. It becomes what it has always been, a tool, dangerous if misunderstood, powerful if mastered. The illusion is thinking it will disappear. The reality is learning how it moves. Because debt will not end, but ignorance can. And in a system where belief is the real currency, clarity is the rarest form of wealth. If you remain unconscious, you pay. If you become aware, you position. That choice is still yours, for now.